Hi guys, welcome back. This is gonna be the video summary of episode 1 of the ICT Mentorship 2023. Please, as always, refer to ICT original content. This is just a reminder, a refresh if you have already went through episode 1 and you would like just a quick splash before going to the next one. Okay guys, let's start right away with the things that we're gonna see in this episode. We're gonna go through where to begin studying ICT, the S&P 500 example regarding the 30th of December 2022, nested Ph.D. erase, time frames for trading the afternoon session, and trading in the last hour of the day. ICT tells us that if you are actually new to ICT, he would advise you to go through the following playlists on his channel, and you can see all of them here. I have to be honest with you guys, personally I've gone through the Market Maker Primer course, the Market Maker series, and that's about it. And then I started directly with the Mentorship 2022. I will be checking the other playlist as soon as I have a little bit more time. There are a couple of things that we should be keeping in mind. The first is that ICT is gonna go live twice a week for 2 hours, more or less, and it's gonna be live and it's gonna be intense. He's gonna go live at 8 a.m. in the morning, New York local time. He advises us to check his Twitter account, and he's telling us actually that he's writing 3 books right now, which is crazy. I'm really looking forward already to get my hands on them. And last but not least, he tells us and reminds us to always put our charts at the New York local time. And you see here on the right side a screenshot taken directly from the video that regards his TradingView account. So down on the lower right corner, you can check there the settings for the time and you can select New York. Let's check now the E-mini S&P futures on the 1-day time frame. ICT is on the 30th of December 2022. He recorded this episode, I believe, on the 1st of January, but he traded on the 30th of December 2022. You can see here the movements on the 4-hour time frame. What ICT tells us is that he believes, considering that it's the end of the year, so it's the 30th of December for when he was trading, that the price would stay within range, and so it would probably not go way high up or way high down compared to the previous days, but it would actually stay within that range. The reason is we are at the end of the year, and when there are these type of holidays, he says that usually the price doesn't move in crazy or unexpected ways. That doesn't apply to news. You probably know that already. When there is a news day, then we should stay out of the market. On the 4-hour time frame, we can see on the left side, signed with this big red arrow, a liquidity void. You can see that the price simply did not fulfill a level, and that's exactly what the price starts doing right after. Here we see 2 big fair value gaps. The first one in red, so it's a big imbalance, and the second one in blue, bluette, and a little bit of yellow. We will be talking more in depth about this one in today's episode, so there is a lot of things going on in there. Just guys, don't get confused or anything. That is indeed a big fair value gap, and you can see it here on the 4-hour time frame. I want to go back to the liquidity void, and I want to show you how ICT tells us to be focusing on this yellow area here in the middle, signed with a big yellow arrow. But there are a lot of other things going on. So within this yellow area, if we focus on it here, we can see that the price taps back to it a couple of times. So we know that this first candle here was aiming for the previous liquidity void, which is the big black candle that right after the void keeps going down. But then the price comes back to it twice. First time it taps back to it quickly, and the second time it actually spends a little bit more time in that price level. Let's move into the 1-hour time frame. Here on the 1-hour time frame, we can observe with more details the price movements. ICT believes that the price will not go above or below these 2 yellow arrows that you see here, which are our previous day's high and buy side liquidity, and our previous day's low and sell side liquidity. ICT tells us about the difference between what is narrative and what is bias. He tells us that bias is actually the direction that we are expecting the price to go, that would be our bias, and the direction in which we would be trading for that day. For example, one day we are bullish, that's our bias for that day. Narrative, though, is a little bit different. Our narrative is telling us how is that day going to trade. So what is it likely to aim for as a result? So as a price level, is the volatility going to be high or is the volatility going to be low? Meaning, is the price going to be moving a lot or is the price going to be staying more or less within the same previous day range? So our narrative is indeed our roadmap, almost our goal for the price. Let's jump now into the 15 minutes time frame and let's observe the price movements. I'm gonna give you here, guys, a couple of screenshots of the 15 minutes time frame, more or less zoomed in. It's interesting to see here, a little bit more zoomed out, all the price movements for the day. We have within the red dotted line the price void, the liquidity void. Above it we have the previous day high and our buy side liquidity level. But we can also see that within the big hourly imbalance, which you can see here with the straight lines, we have also other smaller imbalances, and ICT have signed those with the same color for the 50 minutes time frame and then in yellow for the 1 minute time frame. Those are all imbalances. When we see so many imbalances one inside the others, it means that we have a nested PD arrays. Nested PD arrays, it simply means that the price delivery is organized with order and there are some events that are going to happen one after the other. And that's exactly what we see here. They're all nested one inside the other. As we were saying before, here where you see the big black arrow is where the price formed a void. What did the price do after that? The price taps back into it, goes slightly above it, it forms the previous day high and then starts going lower. When it exits the price void, the price is not able anymore to come back up. But why? Why is this happening? ICT tells us that that's because now this is a balanced price range, and so the price doesn't have enough strength in this case to go back and tap back into it. So I want to show you without almost none of my markups, just like the lines regarding the different fair value gaps, the 50 minutes time frame of the E-mini S&P futures so that you can observe the price movements. Now let's jump into the 5 minutes time frame. I'm going to show you a couple of screenshots, guys, from these episodes so that you can see a little bit better the price movements. So this is the first one, this is the second one, this is the third one. So we are just zooming out a little bit. And this is the fourth one. We can see here the wall price movement, especially when the price tapped back into the price void. ICT tells us that this yellow range here is actually the imbalance that's visible on the 5 minutes time frame. Where you see the arrow, ICT shows us that there, exactly inside the price void, we have actually a fair value gap on the 5 minutes time frame, and the price is not able to go back and tap back into it. And now we know why. Guys, look at the two red arrows and look at the price movements that are shown by those red arrows. Here the price taps first into the hourly and then into the 15 minutes and then at the end into the 5 minutes fair value gaps, one after the other. I want to show you the price movements without my markups and a little bit more zoomed out so that you can see the price movements after it. What we should be noticing, and ICT really stresses their importance, it's these two relative equal highs. You can see them here circled with red. Guys, let's observe the price movements here and let's zoom in this area. What is the story of the price telling us here? So first we have the two relative equal highs, then the price starts going lower, and as we've seen, it first taps into the hourly fair value gap, then into the 15 minutes, and then again into the 5 minutes fair value gaps. What is interesting and what we can see right away from here is that after a little bit of consolidation, the price keeps going down and touches precisely, and you see it here with the red circle, the lower end of the hourly fair value gap, the big fair value gap that we have seen also on the 4 hours time frame. And its precision is incredible. Let's step down now to the 1 minute time frame. ICT at one point, when he goes back to the 1 minute time frame, takes away all the fair value gaps in his remarks so that we can focus more precisely on the price movements. Time is, as always, very important for us. Always put your charts at the New York local time. ICT tells us that between 3 and 4 in the afternoon, we have a small window of opportunity where we can actually be trading index futures. He was telling us that we can easily get 5 handles only in that hour of the day. But we would be looking at finding confirmations that the price actually wants to run and wants to go towards our goal, which is probably going to be a liquidity pool. We are indeed from 3 to 4 looking at confirming that our bias or our hypotheses are correct. ICT tells us that the sweetest spot is actually between 3:15 and 3:45, and that's exactly the moment in which we should be looking to find a setup to enter our trade. Let me show you the whole complete setting of ICT markups here. He tells us that 5 handles range, it's gonna be something that looks like this. And that's a possible target for us from 3 until 4 p.m. New York local time. So guys, let me go back to my markups. As we can see here on top, we have the buy-side liquidity. You see with a vertical line signed at 3 p.m. or 15:00 New York local time. At that time, we would be looking at finding confirmations that the price wants to run to go towards a liquidity pool. So we are looking at confirming our bias. You see here on the 1 minute time frame a dotted black line. That's our midpoint, but not the midpoint of our day. That's the midpoint of our 4-hour price range movement. Okay guys, so this is something different. It's not the midpoint of our day. I got confused a little bit at the beginning when I was doing this summary for this episode, so just pay attention for that, because what ICT tells us is related to trading from 3 until 4 p.m. New York local time. And instead of using the whole range of the day, he uses the midpoint of our 4-hour price range movement. So guys, this is not our premium, okay? When the price goes above it, that acts as our partial confirmation that the price actually wants to go higher. But indeed, we need more confirmations than only that one. The price formed here a first fair value gap on the 1 minute time frame. You see it here with green highlighted and with a big arrow. You see it here without the blue lines everywhere, so maybe it's a little bit more visible. Guys, look at this. We know that the price has formed a fair value gap. And then what does it do? It actually comes back and it taps back into that fair value gap that it formed on the 1 minute time frame. But look at those 3 candles, guys, touching the lower end of the fair value gap on the 1 minute time frame. And they're not simply touching it. Let me really zoom in for us. They are touching it perfectly. It's a perfect execution. That's the work of the algorithm. ICT tells us that he entered the position here, and then he added the position here where you see the second red arrow. But the question is, why was ICT so sure that the price would go higher at that point? First and foremost, because of the time of the day. There are indeed only 35 minutes until closing. Sellers want to close their position before closing, and the price is probably gonna go higher. Another reason is the fair value gap on the higher time frame that will probably support this smaller fair value gap to make the price really jump off of it. And because of the closeness with the buy-side liquidity pool, we are closer to the buy-side liquidity pool, which is on top of where we are right now. ICT tells us that this candle here creates a fair value gap, but also it creates a lot of acceleration. He tells us that this fair value gap has a high likelihood to stay open, so it's a getaway fair value gap because the price is getting away from it. Considering that the price just went into the fair value gap, tapped into it and went higher, precisely touching also its lower boundary and jumping back right off of it, that also means that it's not likely that the price will have a reversal right away. So the price is not going to be consolidating, which is the first arrow that you see on your left, and then expanding, and so going higher, and then going lower. So the price will not be doing the movement that you see the arrows doing. Now, to keep going with the ICT entries, he also shows us that he actually had 1, 2, 3, and 4 entries, and the 4th entry is actually a very interesting one. So, right after the fair value gap, the second fair value gap, ICT added another position here where you see the black arrow. But why? He tells us that that's because it's a breaker. Okay, but why exactly? Why exactly there? ICT entered there because it's a breaker, and he tells us that the reason relies in that candle that's highlighted here with the red circle. Let's zoom in. ICT tells us that this candle is very important, the one that has a big red arrow on it. ICT takes the fair value gap that we have seen before and it flops it and it makes the orange part go higher. And so he uses that whole candle as an area to be highlighted. He tells us that that's a balanced price range. It's important that the price does not go back into that area here below that first short-term low. So ICT entered again in that last position that you see here with the last little blue arrow on the right side, because we see here a short-term low that failed to go lower, giving us a confirmation that the price will go higher, which means that the price was simply accumulating more buy positions. That gives us a confirmation that the price will go higher, and what is likely going to happen is shown here with these 3 red arrows, so it's consolidation, expansion, and continuation. ICT shows us that this is spooling. The algorithm is buying and buying and buying some more, making the price go higher. We see in this area a very few black candles, so bearish candles. The majority of them are green. Highlighted here with a green circle and also a big green arrow is a smaller liquidity pool. The algorithm recognizes the 2 old equal highs that we have seen before on the 3864 level as an attractive force. So it's attracted to them. It's gonna go towards them. Because of such a high movement and because of spooling, it's really not likely that we will see the price rallying down. Guys, remember, the algorithm is there and its precision, it's incredible and mind-blowing. ICT, it's the only author of the smart money concepts, and the precision with which he is driving us to understand the markets can really not be argued with. Let's go, guys. This is the way. God specializes in giving people a fresh new start.